state finances have been delivered that frightening body blow to the U.S. economy. Global finances, specifically those in Europe, are also weighing heavily on the U.S. You're seeing all of that reflected right now in the European markets and in equity futures. Now, these are all factors that Terry Miller considers as head of the Heritage Foundation's Index of Economic Freedom, which ranks the economies of the countries around the globe. Terry is the former ambassador to the United Nations Economic and Social Council, here with us from Washington. So, Terry, tell me how your world has changed. Your world outlook has changed after this downgrade.
Well, I'm not surprised by this downgrade. Economists have been predicting for months that we would have a downgrade in the U.S. debt rating if we kept building up this massive debt, if we kept our deficits rising. I think the deal in Washington last week didn't do anything to change that course. Might have slowed it down just a hair, but we're still going to see U.S. deficits increasing into the future. And it just makes sense that when you have that kind of supply flooding the market of U.S. Treasuries, the market for them is going to soften. I wasn't surprised at all. I think the S&P move is something that's been coming for a long time.
It has been. I mean, obviously it was telecast quite boldly by the agency a month ago. But Terry, when I say how your outlook has changed now, I mean, one of the a hedge fund manager that I had talked to over the weekend said, look, maybe we have to start looking at countries, not as emerging and emerged or developed and developing, but maybe we have to start ranking countries by a creditor nation or a debtor nation. We have to now start thinking differently about countries around the world.
Well, I think that's true, but at the bottom, what we need is to restore growth around the world in these economies. And it's not entirely clear that government actions, at least of the traditional kind that the Obama administration is contemplating, are the right way to go. It may well be that in a country like the United States, where the things the administration has been doing have harmed the economy, maybe what we need is a lot less government. We have regulatory overload in the United States right now. We desperately need to see growth restored in the European region, but at the same time, we have to undertake government austerity there. We have to see those governments reining in their spending. They've built economies over the past 20 or 30 years that are based on government spending, government involvement in the marketplace. What we need is to find a way to back governments out of those economies, let the free market take over, and get the private investment and the job creation that will get us back on a fast growth path.
Terry, it's Erik Schatzker here. What's going to incentivize policymakers to do anything like that? You said a couple of minutes ago the market for Treasuries is going to soften, and maybe that would have an impact. But today it's firming. 10-year yields are under 2.5% again.
Yeah, there's really no alternative to the U.S. Treasury bond now as a store of value for countries around the world. There is no other market that can compete with the U.S. Treasury market for people to hold their government reserves. So I don't think we're going to see a lot of softening in the short run. We're seeing countries fleeing other markets and going into Treasuries today, and that's going to continue to happen in a time of uncertainty. But what we need is gross domestic product is ultimately about production. It's about employment. It's about people getting up, going to work, doing their jobs, and producing something in the economy. In Europe, for years, we've had people who are taking the month of August off right now. Anyone that travels to Europe right now will see most of the shops shuttered and closed. People work 11 months. They get paid for 13 months in Europe. Maybe we need to reverse that. Or maybe we at least need to have people working 12 months and producing 12 months worth of goods and services. It's all about getting the unemployment ratio down in the United States. We've got over 9% unemployed, not producing anything. We've got another 4 or 5% that would like to work, but just have dropped out of the market entirely. So we really need to back government off and get the Obama administration to stop doing what it had done, what it's been doing.
Terry, I mean, obviously there's going to need to be some major adjustments around the world, given all the austerity that is being implemented, and markets are calling for that austerity in some measures. Terry, thank you very much. Terry Miller, the director of the Center for International Trade and Economics.